Welcome to Fixed Income Focus. This channel is all about explaining fixed income markets clearly, practically, and from a market professional perspective. In this first video, we're going to start right at the beginning and answer a simple but very important question. What is fixed income? By the end of the video, you'll understand what a bond is, who issues bonds, who buys them, and how the fixed income market is structured. What is fixed income? Fixed income refers to a class of investments that provide predictable cash flows over time. The most common fixed income instrument is a bond. When you buy a bond, you are effectively lending money to an issuer. In return, the issuer agrees to do two things. First, they pay you interest payments, known as coupons, at regular intervals. Second, they repay the original amount borrowed, known as a face value or principal, at maturity. Because these payments are known in advance, or at least contractually defined, we refer to this asset class as fixed income. This makes bonds fundamentally different from equities, where dividends are uncertain and there is no maturity date. Now let's look at a simple example. Suppose you buy a bond with a face value of $1,000 and a coupon of 5%. That means the bond pays you $50 per year in interest. If the bond matures in 5 years, you'll receive those coupon payments each year, and at the end of year 5, you'll receive your $1,000 back. That basic structure, coupons plus redemption at maturity, underpins almost all fixed income instruments. Now let's talk about who actually issues the bonds. There are 3 broad categories of bond issuers. First, governments. Governments issue bonds to finance public spending, manage budget deficits, and refinance existing debts. Examples include US Treasuries, UK gilts, German bonds, and Japanese government bonds. Second, we have supranational institutions. Supranationals are entities whose members are governments. They are typically set up to finance development projects or provide financial stability. Examples include the IMF, the World Bank, the Asian Development Bank, and the Asian Infrastructure Investment Bank. Thirdly, we have corporations. Companies issue bonds to raise capital for things like investments, acquisitions, or refinancing existing debt. Compared to government bonds, corporate bonds typically offer higher yields to compensate investors for credit risk. On the other side of the market, we have investors, the buyers of bonds. Broadly speaking, we divide bond investors into 2 groups, real money and fast money. Real money investors include pension funds, insurance companies, mutual funds, asset managers, and sovereign wealth funds. These investors typically have long-term liabilities. For example, pension funds need to make payments decades into the future. As a result, they care deeply about predictable cash flows, duration, and long-term returns. Fast money investors are mainly hedge funds. They tend to trade more actively and are often focused on relative value, macro views, or absolute returns, rather than holding bonds to maturity. Both types of investors play a critical role in the functioning of the fixed income markets. So, next we look at how do all of these market participants actually trade with each other. This is where the investment banks come in. Banks act as market makers. They quote prices at which they are willing to buy bonds and prices at which they are willing to sell bonds. This provides liquidity to the market and allows investors to transact efficiently. Without market makers, it would be much harder for investors to buy or sell bonds when they want to. Why fixed income matters. Fixed income markets are enormous. In fact, the global bond market is larger than the global equity market. Bond yields influence mortgage rates, corporate borrowing costs, currency markets, and central bank policy transmission. Understanding fixed income is essential for anyone interested in macroeconomics, investing, or the financial markets more broadly. In this video, we've covered what fixed income is, what a bond is, who issues bonds, and who buys them. In the next video, we'll take the next step and look at how bonds are priced using discounted cash flows. Thanks for watching Fixed Income Focus.